What's going on, guys? It's John DeYong here, and it is Good Friday. So happy Easter to all. Hope you're all doing well. Hope you're all staying safe and enjoying some nice family time at home, probably some quiet time. Maybe not quiet time if you've got young kids running around, but I hope you're all staying safe and keeping indoors and doing all the right things as you should at this time of the coronavirus. It's a pretty full-on time right now, but I hope you're all doing well and have a good Easter. Corelogics has just released the April housing report, so we're going to go through that right now. Bit of an interesting one this year. Obviously, the market is going through a bit of a change at the moment due to the coronavirus. Auction clearance rates and all that sort of stuff are being reported pretty heavily. So it's going to be interesting to see what's going on in there. Obviously, the market's pretty much come to a halt. I mean, there's a lot of private sales and stuff still happening, but yeah, we're not seeing numbers like we were sort of even 2 weeks ago, 3 weeks ago. So very interesting time right now, but let's delve into it and see what we find. So yeah, normal monthly chart pack, start pack, except this has got a special edition, COVID-19 and the Australian housing market. No major change here really, same as usual, still a $7.1 trillion industry, so still seeing some strong numbers there. It's going to be interesting to see what the Australian listed stock starts recording at if the ASX keeps coming down. But it's going to be interesting times ahead. But yeah, I think I've delved into these numbers too many times before. So if you're unsure what all of this sort of means, maybe go back and watch the first or second one, and you'll see what those sort of numbers mean there. Now, this is a really cool chart. The impact of the housing market from the coronavirus remains uncertain. Previous shocks have seen housing values relatively insulated, while volumes are more susceptible to volatility. Housing indices versus all-odd index across previous stocks. So what these graphs are, and they might be pretty hard to see on the screen, but essentially, these are going through all the big events and how the housing market has performed against all odds. So, this is Black Market Stock Monday. This is the Asian financial crisis. This is the tech wreck, the GFC, the macro-prudential, which is, kind of what we just saw. And then down here is the housing volume versus all ordinaries index across previous shocks, 5 years either side of the event. So, so this is 5 years either side of the event. Both are 5 years at either side of the event. Housing volume. Okay, so this is indices and this is volumes. So, if we just have a quick glance, look at the all odds go up and then completely crash down. And, we're not probably seeing it that one, but it's kind of similar in the GFC, in the Black Monday stock, even in this macro-prudential, it's sort of done a little bit, but not as dramatically. And we see the housing market is slow down here and then dramatically increase up here. And you can see this trend through all of these periods. They're, consistently going up. I mean, if you look at the GFC, it even came down a little bit, but then started to rise again and all that sort of stuff. And so when we look at volumes, sort of same thing here. It lags a little bit. That dip lags a little bit. So we see the volumes continue to go up, and then there's a bit of a lag, and same here. But it's crazy to see. And I think probably the reason that they put this in the chart this month is just for some background about how the housing market performs in these sorts of economic conditions. Obviously, we can't compare conditions to conditions because they're completely different. Like if we take the GFC, that was a financial economic impact rather than a pandemic that's causing the economy to halt. So, in relative terms, they're the same thing. The economy's stopping, things are slowing down, blah, 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 blah. But, in real terms, the economy is stopping. The economy was very strong before the pandemic came through. So hopefully if we can, close off the borders, lock people down, identify where the virus is currently, get it out of the system, flush it out, keep the borders closed, keep Australia safe. And we've seen that. We've seen the daily cases come down dramatically, get rid of the coronavirus in that format and our economy can start to pick back up again. And, if it's a short-term thing, we might even see a V-shaped recovery, but it all depends on how long it's going to take. If we're seeing 12, 18 month, coronavirus lockdowns, that's obviously going to have a significant impact on the environment. But yeah, I guess back to why they have this chart in the monthly pack today is, just to demonstrate how strong the housing market is in these sort of conditions, and, how they sort of do rebound and consistently have that trend of going upwards. So good to see. Housing values have been relatively insulated from financial shocks historically, but have been more reactive to credit tightening events. So again, this is a linear sort of graph of all these major events that we just saw, Black Monday, financial crisis, dot-com bubble bust, global financial crisis, China steel glut, and this is the 30% lending cap on home loans. And I guess what they're saying is, if we look at these negative periods, if you look at the dot-com bubble, it didn't even go into negative period. Nothing happened here and it went into negative. And so I guess what they're saying is, they've been relatively insulated from the financial shocks in the history. So they're relatively solid. And I guess what they're trying to reinforce is that, historically, the property market hasn't fallen off a cliff. Obviously, if we look at Ireland and the US, they have, but in Australia, they haven't. And obviously we haven't had the debt burden that we do today historically. So it's a different event. It's a different thing that's happening. So it's going to be interesting to say, but I think they're just reinforcing that point. Annual growth rates understate the recent slowdown of the momentum, but point to improving market before the onset of COVID-19. Yeah, so this is the annual change in dwelling prices. We're not really seeing any here because it's the annual change. So still looking upward because the data is so lagged behind, and we're looking at it annualized. So we're not going to see any major change there. Again, we're still seeing strong Sydney and Melbourne at 13 and 12%, but that may indicate, how volatile Sydney and Melbourne is. If it grows by 13 and 12% in 1 year, it can also come down by 13 and 12% in 1 year. So, those bigger, stronger markets are more susceptible to bigger changes because of that price discrepancy. So, if the median house price in Sydney, I don't know what it is, but say it's 800,000, and you compare that to a city that has a median house price of 500,000, if you think of that in relative terms of, the annual income, if the annual income's $80,000, then $500,000 is significantly less compared to the average income than $800,000. So that $800,000 market can be really susceptible to big impacts like this because of the supply demand sort of the drivers that have brought them up to that $800,000 mark may now pull them back down because of all the things that are happening in the market with unemployment and underemployment rising, people losing their jobs, blah 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 blah. So yeah, I think the biggest thing that we will see is Sydney and Melbourne get impacted from this. But again, it's all relative to how long the pandemic is going to pan out. Each of the capital city markets were well into the upswing before the onset of COVID-19, with exceptions of Hobart, which was starting to lose momentum after the long swing. So yeah, annual changes, but broken down to those markets. So some numbers on the left, on the right here, broken down into those markets. Nothing major to report on here. I've gone over this graph a couple times recently. So if you want to go into more depth, go back and watch one of those ones. But yeah, essentially we're still seeing Darwin and Perth in that negative area, where we've seen some stronger growth in all other capital cities. Now, this is a really interesting one. This is the rolling 28-day change in daily home value index combined capitals. So, since the 16th of the 3rd, and I think the auction market stopped on the 20th of March. Correct me if I'm wrong, but I think it was that weekend. And it's funny to see how we've sort of been impacted here. Then the market's closed down, then it's significantly come down, but it's sort of stabilizing now. I mean, obviously we're talking days here, so it's not a true indication of stabilization, but we're sort of stabilizing here. We've sort of come to the conclusion that, okay, auctions have stopped, private sales are now becoming more common, and we've had that initial reaction to the market. And this is bound to happen considering what we're going through. This is a 1 in 100 year event. So this is bound to happen, this sort of reaction. And, even if you look at the numbers at 0.65, right, like it is low than it's ever been, but it's not that low compared to the 19th of the 1st. So, when you think about this in relative terms, obviously we're seeing the reaction from the market in that top bit, but it's not significant in terms of that daily index. The Corelogics Daily Home Value Index showed a change of pace halfway through March, which was expected. Despite this, the rolling monthly change remains in positive territory. Yeah, of course, because it's a monthly thing. So we're seeing this on a month-to-month basis. Not this is a daily, but the next one will be a month-to-month basis. So we're not really seeing that impact just yet because it only came through, and they're saying halfway through March, but really it's like 1/3 through March. So quarterly and annual change dwelling Sydney. So Sydney dwelling values increased 1.1% in March. So that's a lot slower than January and February. Note that. So it's slowing down a little bit, and we can sort of see that with this decrease here. Dwelling values increased 3.9% in the quarter. So that's based on a quarter. We're really looking at the pandemic in the last 2 or 3 weeks. So you can't compare quarter to weeks. Sydney dwelling values are up 13% in the past year. Year to weeks doesn't really give you any correlation. Sydney dwelling values are negative 2.7% below the record high, which was July 2017. So they're even really close to that peak in July 2017. And I think, that gives you an indication of where the market cycle is right now, and considering what we're about to go into and how long for, what could potentially roll out. Melbourne, same sort of numbers. We've only seen an increase of 0.4%, and dwelling values are at their record high. So although we're at our peak, we're beyond our peak, we're only growing a little slower. So although, and this is what they alluded to back into the daily chart, even though the month is reporting higher, the daily index is coming down because in the middle of March, so it's not showing it in the whole of that month. Dwelling values increased 2.9% in the quarter, so quarter compared to weeks. Melbourne dwellings valued by 12% in the past year. So yeah, again, it's very early stages. This data is very lagged because obviously, dwellings have slowed down. We're not really, auction clearance rates have slowed down. So we're not really seeing, sales going like crazy, and even the numbers of sales that are happening are slowing down as well. So the numbers that are being reported can be skewed because of the numbers of sales that are coming through. So even if, there's really bad stock on the market, or not right now, but in a couple of months' time, if we start to see some less quality stock on the market and it's being sold pretty cheaply, and, there's a lot of vendor discounting, then, that doesn't really indicate what the value of the prices are in that area, because the stock on market is not that great and there's not many transactions happening. So it's only reporting those lower quality properties. And I think, there's going to be some confusion about that in the future, and it's going to be hard to sort of, see how relevant the quality of stock on market is and what the numbers are showing us. And that's why I think, going forward, specifically when I'm doing these types of reviews on these types of reports, is just to keep in mind that the data that we're going to be seeing over the next 6-12 months isn't going to be typical. So we have to take it with a grain of salt, and, they seasonally adjust data at the RBA and other places as well. So, we have to take that into consideration. Seasonally adjust it, take the pandemic into a perspective, and just understand that the data that's being represented may not be 100% true and accurate and can be skewed. Brisbane, so 0.6% increase in Brisbane compared to Melbourne, which was 0.4. So good on you, Brisbane. Dwelling values increased 1.6% in the quarter. What? They don't have a month there, do they? Oh no, the month is the top one, yet. Brisbane dwelling values are up 3.1% in the past year. Brisbane dwellings are currently at a record high. So again, think about where Brisbane is currently in the cycle. It's at a record high. So what does that mean, given the circumstances where we're going to go? Change in values in Adelaide. Dwelling values increased 0.3% in March. Dwelling values increased 0.6% in the quarter. So still some growth there. 0.9% in the past year. That's not that strong. But good to see them come out of that sort of dip there, as we're seeing those, quarterly changes come down a bit. So, and Adelaide's at a record high as well. Perth values are up 0.5% in March. Stronger than Melbourne. Go Perth. Dwelling values increased 0.9% in the quarter. Perth values are down negative 3.1% in the past year. So yeah, pretty interesting with Perth. Perth dwelling values are now negative 20.7% below the record high. So still plenty of growth, 20% of growth left in Perth to get back to the peak. And as you're seeing, if you look at this sort of March 18, maybe a bit later, maybe May 18, you're starting to see this growth sort of come down and now go back up. So, really low market here. around March 19, and then since March 19 we're starting to see that growth. So interesting times ahead for Perth. Hobart, negative 2% growth in Hobart. Dwelling values increased 1.4% in the quarter. So interesting to see that Hobart has been significantly impacted, and we're starting to see that negative result come through for the month, which may mean that see, this is interesting. The last line: Hobart dwelling values are currently 0.2% below the record high, which was in February 2020. So last month they were at a record high, which means they're sort of haven't peaked the cycle, but they're at the top of their cycle. You can never pick the actual top, but they're coming to the top of the cycle. And so now that we've seen this hit, we're seeing prices come down, and we're seeing that decreased value come down. So very interesting. And we might sort of see that in the other markets. I'm not saying we are or we aren't, but it is a good indication. Darwin, values increased 2.0% in March. Dwelling values increased 0.6% in the quarter. Darwin dwelling values are down by negative 5.4% in the past year. So some negative growth there in Darwin. Interesting to see that last quarter is showing a positive growth. So could be a sign of things to come. We're seeing a good recovery here, but obviously no indication here of the coronavirus having an impact. Darwin dwelling values are negative 31.4% below the record high, which was in May 2014. Yep, so the record high was a long time ago, even before this chart. This is March 15th, so long time ago. ACT increased 0.6% in the month. Values were up 1.7% in the quarter. Cool, some growth there. No indication of slowing down due to the coronavirus just yet. ACT dwelling values were up 4.7% in the past year, and the market's currently at a record high. So good to see ACT. All right, sales activity over the past year had trended higher, and it's being sustained above the decade average of 37,601. So very interesting. I think this number is going to significantly come down. Monthly sales with 6 month. So this is a 6 month moving average. So what they do is they, from this point in time, they take the previous 6 months. And then from yesterday, they take the 6 months before that. And the day before, the 6 months before that. So it's a rolling 6 months average. So we're not going to see, daily spikes of ups and downs and ups and downs. It's a rolling average sort of thing. And so we're not going to see any indication of the coronavirus having a massive impact right now, because we're thinking of 3 weeks of market slowdown and listings coming through in a pool of 6 months of data. So in relative terms, it's not a significant amount of the data that's in there. We're not going to see an impact coming through just yet, but interesting to see. How were we going anyway? We'd sort of see that V shape come back when you look at when you look at the numbers there, and we're trending higher than the decade average, so we're selling more than usual. But sales volumes have been dampened by negative economic shocks and are expected to fall dramatically over the coming month as consumer confidence declines. Yeah, that's pretty much what I was just saying. So onset of the global financial crisis was here. This is modelled sales volumes 6 month average, and Westpac Melbourne Institute Consumer Sentiment Index RK. Yeah, model sales volumes monthly. Yeah, so the light blue is the monthly, the darker blue is the 6 month, and the orange is Westpac's Melbourne's Institute Consumer Sentiment Index, also known as the RHS. So you can sort of see these sale volumes come down during of the onset of the global financial crisis and then come back up. And this is really just a 1 year or 1.5 year period. So we might be seeing listings not trading that long for a good amount of time. A year and a half, even though it doesn't look like much on this sort of graph. This is starting in 2000 to this is 20 years worth of data, so it doesn't look significant here. But a year and a half of a slowdown of a market is pretty significant. Growth in rent values was also gathering momentum. COVID-19 may create higher vacancies as job security worsens, and short-term holiday rentals are converting to long-term accommodation. So we were seeing some strong rental come up here with the rental rates, annual change in rental rates. So 1.4% was coming, back up from, 0.2, 0.3, 0.4 there. But yeah, I mean, what's happening in the rental market right now is pretty significant. I mean, we've sent everyone home. All our international people that were renting housing in Australia have now been sent home, so they're not going to be renting houses in the market right now. Obviously, no one's coming for short-term accommodation. No one's coming for, weddings, holidays, visit family, or anything like that. So all of a sudden, this big Airbnb market that's just come out of nowhere, and we have two of them, so I can talk about this. And we've actually moved back into one. This is one now. This is probably why you're seeing a different change of scenery. But this whole market right now is shutting down. And so everyone who's got a listing on Airbnb can't rent out their property anymore because no one's wanting to rent their places, and they're putting them back on the market. And then everyone who's gone home, the places that they were renting are now coming back onto the rental market. And we're sort of seeing all of these rental listings come onto the market, and it's a pure supply and demand driven thing. So as supply of rental markets increase and demand is coming down because there's not many people wanting to rent, and people that are going through financial hardship might, although there's plenty of incentives and stimulus coming through the market right now, they might be moving back to family and friends. They might be moving back to, their friend's couch or wherever it may be, and not renting a place out. And so there's less and less and less demand, more and more and more supply. And so we may see a decrease. I'm pretty sure we're going to see a decrease in rental rates over the next 6 to 12 months. Nationally, gross rental yields compressed a further 2 basis points over March to 3.76%. Gross rental yield. So yeah, we're seeing that gross rental yield come down, and this may be happening. This may have happened in March because property prices were increasing. And so what happens when property prices increases and rents that are on a 12-month contract are staying the same? Like rental prices don't go up and down depending on, in a normal market, that they don't go up and down per month. So as property prices increase and rental prices stay the same, the rental yield is getting less and less and less because the property prices are going up, but rental yields are staying the same. So essentially, what we're seeing here is, and what's going to be different moving forward is what I'm trying to say, is if new rental agreements come in, you can pay cheaper rent for those who can't afford to pay their rent, go on a rental hiatus, or they pay half rent until 6 months and then they pay it all back after 6 months or whatever it may be. We may see these rental yields continuously coming down, but obviously that's going to be dependent on the property prices as well. So it might stay relative. If property prices come down and rental yields and rental amounts come down, then the rental yield will stay relative. If property prices remain and then rental yields come down significantly because of all this new supply that's coming on the market, then we will see that rental yield continually come down. So it's going to be interesting to see in the next coming months. Days on market was lower over the year to March, though this may steady as housing demand eases. Yep, so days on market is just how long a listing stays on the market before it sells. This is 2019 compared to 2020. And you can see significant changes. The bottom of the market in 2019, not the bottom, but around then, properties were staying on the market for 69 days in Sydney. That's longer than 2 months. And now we're down to 33 days, which is just over a month. And you think of an auction campaign that only rolls out for 30 days. So, they're pretty much selling like hotcakes. But yeah, obviously the coronavirus is going to have an impact on that. It's going to be interesting to see that the numbers that get reported, because obviously less and less people are going to be having their listings on the market. Those that can hold on to their properties, you can get bank support, mortgage holidays, all that sort of stuff. If they don't have to sell their property, if they were going to sell their property but they don't have to sell their property now, we might see less listings on the market. So these numbers are going to be interesting. And then there's, depending on how the market goes, properties might sit on the market for ages if no one's buying. So it's going to be interesting, very interesting time. And, and this is the whole point of looking at the data in the future. We've got to understand, it's not typically being reported, although it is relative to what's actually happening out there in the market. It can't be used for modeling to predict what's going to happen to the property market, because it's just not solid data, and it's completely skewed. And so, we just got to take that in consideration of when we're analyzing this market. Most markets have seen a reduction in vendor discounting year on year, with the exception of ACT. Yep. So people that have properties for sale are not discounting them as much, and that's obviously going to happen in a strong seller's market. So this could fall off a cliff if property prices come down. People are significantly discounting their properties, but I don't know how they calculate, what an actual value of the property is and what the discount is. So maybe it's like what they originally listed it for and what it actually sold for, that in comparison. But yeah, we'll have to see. New listing numbers are tracking lower than a year ago and likely to fall materially over the coming months. Very interesting. So this is, all of the previous years. And as you can see, this sort of December, January period is the Christmas slowdown, and we come back sort of strong mid-Feb there. And it's interesting to see we didn't even come back as strong as we had in previous years. Like given the strength of the market in sort of January, February, we didn't come back. But yeah, it's sort of trending in the same way, but not as strong as previous years. This is a rolling 28-day count too. Cool. So we can sort of, that makes sense to do it at rolling 28 days. We could, it's going to be interesting to see, although this typically does come down around that Easter period. January, February, March, April, May, June, July. Why have they got 2 Marches? Yeah, interesting. So it obviously slows down for this Easter break, which we're in right now. But yeah, it's going to be interesting to see how or if it picks up after the Easter break. So going to be a good one to watch. Sydney and Melbourne are the only broad regions where new listings are higher than a year ago. So yeah, lots of listings on the market right now for Melbourne and Sydney compared to all of the other markets. Where are they? Melbourne and Sydney, so stronger. So Melbourne's only up 1.3%, so that's really not that much. And Sydney's up 10.8%, so change from last year. Very interesting on the numbers. And that might be a reflection of the market. That probably is a reflection of the market, before the coronavirus. So it's going to be interesting to watch these numbers in the coming months to see, are there more people putting their properties on the market or less? They're holding on to them. In the final week of March, the clearance rate was 37.3%. This was due to the ban in on-site auctions, which saw 50.2% of auctions withdrawn. Withdrawals are counted as non-sale results. Okay, cool. So even though the clearance rate was 37.3%, which, clearance rate is often quoted as being a strong indicator of, identifying turning points in markets. With the strong auction clearance rates, properties are selling, at the drop of a hat every weekend, they're selling. With low clearance rates, properties aren't selling as much, they're passing in and people are buying the property after they're passed in. And so what that really low clearance rate is, obviously there's a ban on auction. So that number is really and this is what I'm saying about data going into the future, it's not a true indication of what the market is actually representing. And we can see this with 50% of auctions are being withdrawn. So half of the market took their auction off the market, and that's been counted as a non-sale result. So whether if it's sold or not before auction or after auction, or if it's being sold right now, it's still counted as a non-sale auction. So that's why we're seeing that significant, pretty much off a cliff drop to 37.3%. As well as many auctions being withdrawn, 66.7% of properties were sold prior to auction. So there you go. The proportion of auctions withdrawn and sold prior to a combined couple of cities. Yeah, so 50% of auctions were withdrawn before the thing, and usually it's at around 5%. Looks like. So obviously that's because auctions have been called off and we can't do auctions anymore. So you can't take that number with a grain of salt. It doesn't actually mean anything in comparison to what's happening on the market. It's just the pandemic causing a shutdown of the market. But this is what is really interesting is, the portion of auctions sold prior, which means 66.7% of properties sold before their auction. And that might just be because there wasn't an auction. It's going to be interesting to see how they're actually recording that data and reporting that data. But yeah, when you take that in comparison to what it typically is, it looks like it's about 20 to 25% there, typically of auctions that get sold properties that get sold prior to auction, but yeah, 66.7% is huge. And I guess that sort of indicates that properties are still selling. And that's what we're going to have to identify moving forward, is how they're selling, how we identify those numbers, how we look at those numbers and what they actually mean. And we don't use the clearance rate as a indicator of what's happening at the market, because we can't, because the data is just completely skewed. Trend data indicates that dwelling approvals were starting to rise following declines from the end of 2017. Yep. So construction approvals were trending a little bit higher from the macro-prudential shutdown or close down or slow down, whatever you want to call it. But yeah, construction is still underway at the moment. So, are people buying houses to build? I don't know. I think builders are going to have to put in some serious discounts to get sales and all that sort of stuff at the moment too. So going to be interesting to see how this sort of market goes between new and existing listings. Are people going to buy existing listings? Are people going to buy new houses? Are they going to build? It's going to be very interesting to see those numbers and how people want to go away. I mean, obviously, builders are a business and they operate under making profit from doing construction. And so to remain in business, they're going to have to continue to get sales. And to get sales in a market that we're in now, they're going to have to significantly discount their property price or their construction costs. And so obviously they're going to be doing that from a purchasing side. They're going to reduce their costs from purchasing, but obviously going to have to put that forward to their clients as well and try and get sales that way. But yeah, interesting time to see what's going to happen. In the lead up to COVID-19, aspects of lending conditions eased slightly, but the financial system remained strong. So weighted average variable rate of new loans funded against the weighted average assessment rate used for serviceability. Oh, this is really cool. So, when you go to apply for a loan at the bank, they don't just take the interest rate that they give you. They actually have a serviceability rate, which they use, in the worst case scenario that interest rates were to rise. And obviously, the RBA has mentioned that interest rates aren't going to rise until unemployment's back to 4%, which is probably going to be 3 or 4 years away, considering the market that we're in. But this has significantly come down over those months. We were getting assessed at 7.3% assessment rate, and now we're getting assessed at 6.3%. So it's a 1% drop, which means our borrowing capacity is increasing. Given that we're still employed and money's still coming in a strong financial position, but our borrowing capacity, given we're in the same circumstances 12 months ago, has now increased. So that doesn't mean, go and borrow till your eyelids are full. We should still be, looking into the future, checking out job security, all that sort of stuff. I mean, this whole thing is really shown people that job security can go at the drop of a hat. Even if you've been there for 10 years, 20 years, 30 years, if the company can't operate or afford to pay you, then, the job security is not there. You'll be unemployed. So I think, taking, our debt to income ratio is very important, and we don't want to be in a position, although the banks are giving people, mortgage repayment holidays, and there's plenty of stimulus and incentives and all that sort of stuff out there right now. We don't want to be in debt to the eyeballs and, be in a position where we have to approach the bank to get a 6-month holiday. Like that's, it's unfavorable. I mean, it has to be done in these circumstances, but, no one ever wants to be in that position, especially considering that the interest is just going to be accrued onto the debt anyway. So although we're not paying it over this next 6 months, we'll be paying it over the next 30 years after that. So, pretty full on. Portion of new loans funded on interest-only terms. Wow, so interest-only terms have significantly come down. They peaked at 20.5% in June 2019, and now they're 17.7% in December. So very interesting there. Portion of new loans funded with less than 80% LVR. So yeah, lots of people, as you can see, people are buying, is that less? Yeah, less. Oh, okay, this isn't a zero indicator graph. So, it's starting at 35% or something there. So even though these graph, this is a wrong way to graph any chart. You should always start at zero. But because this is false leading. But yeah, I mean, we've come from 36.4% to 38.6% of loans being unfunded on a less than 80% LVR. So obviously people have more money and are buying houses with a 20% deposit or more. Why is this not moving on? Monthly value of new finance commitments, owner-occupier compared to investor. Yep, so owner-occupiers have taken up a significant portion of the market. I mean, these sort of trend together, but this is investor compared to owner-occupier. We haven't seen investors rebound as much as owner-occupiers have. And so I think the big drive from the sort of market V-shaped return that we were seeing early to 2020 was purely owner-occupiers. Portion of new lending of investments, housing, excluding refinances. So yeah, the decade average for investors was 36%, and we're still significantly down from about 2017 to 27.5%. So investors as a share of the market. So we're only seeing 30% of investors or less in the market. New home lending increased 4.6% in January 2020. Wow, 4.6% new home. The relatively low portion of investor participants provides some insulation for the housing from the retreat of investors as results of the current downswing. Yeah, okay. First home buyer participation was steady over January, led by declines in Victoria. This suggested upsizes, downsides are most dominant in the new home lending space. Okay, cool. So upsizes and downsizes are taking advantage of the market currently. In Victoria, I think they said. Victoria's down 2.2%. So first home buyers are coming off in Victoria. What does that mean? I mean, there was plenty of grants and stuff early this year. Yeah, that's very interesting. It's very interesting data. First home buyers as a proportion of owner-occupier finance commitments. Yeah, interesting. I mean, Queensland's still at 2.6. New South Wales has come up at 0.6. Maybe they got scared of the market rebounding so fast. Not scared, but didn't want to get into a market that was jumping up so quickly. I don't know. Over January, investor participation continued to decline in most states and territories. Yep, so this is investors again, obviously coming down significantly in all markets. No real distinction there to come across, but it's obviously down. This line's the decade average, and this is investors as a proportion. But as you can see, in 2017 when the market was really hot, investors were nearly 40%, and in New South Wales they were 50% of the market. Yeah, that's kind of interesting. So in New South Wales, investors were 50% of the market. So half the people in the market were buying property were investors, and the other half were owner-occupiers. And, the market is purely driven by owner-occupier appeal. Like, that's what people want to buy. Where people want to live is what they want to buy, and that's what's going to push up pricing. So if you've got a whole bunch of investors buying investor-grade stock, it's not a good recipe. It's really not. And, for those people that were buying in 2017, they went through a pretty hard time, 18, 19, and now it's going to be interesting to see where they end up. If there's a whole bunch of investors that are still holding on investor stock from the peak of 2017, 50% of the market were buying back then. It's going to be an interesting time to see what happens there. Obviously, they've got 6 months of repayments to hold on to their properties. But, if this is a 12, 18 month virus pandemic, going to be interesting to see what happens there. The cash rate is now at a new record low following 2 reductions in March, with fixed rate mortgage products expected to see the largest reduction. Yep, so we're seeing, the cash rate's down to 0.25%. It's the lowest it's ever been. The interest rates are the lowest they've ever been. I'm refinancing at the moment. I just locked in a loan for 2.05%. Fixed P&I, but it's so cheap at the moment to get lending. Very low time in the market. Average mortgage rate by product, Feb 2020. So investors are still, it's still not too bad, but owner-occupiers are still getting a lower interest rate. And then, this is the premium between the two. It's 37%. So I'd love to go back the couple of months or years and see how different these basis points are. Are they increasing? Are they decreasing? Oh, this is the month. So, it's pretty much in line really. So it's not they're both coming down, but not, investor interest rates aren't coming down faster than owner-occupier ones are. And that's it, guys. Thanks for watching today. Really appreciate it. I hope you got some good information out of there. Pretty insightful for me. There's some pretty interesting data, as I said, going forward, looking at any data in the property space or reporting or anything like that needs to be taken with a grain of salt. We can't take, numbers like 50% withdrawals or 37% auction clearance rate and use that as an indicator to model what's going to happen in the market. No one can predict what's going on in the market right now. No one probably will be able to for the next 6 months. It's going to be completely up to what happens in Australia, how we deal with the virus, how we accommodate it, how we get rid of it, and then what happens after that. If there's a big wave 2 that comes through, we could go through, a second series of lockdown. It all depends on how we react as a country. And what I'm trying to say there is, if lockdown restrictions were loosened and, we're allowed to go to gyms again and to the beach and all that sort of stuff. And then there's this big second wave of the pandemic, we could be in lockdown for another 6 months or 12 months, or they might just lock us down completely. So, and the borders, international borders and all stuff like that as well. If we've locked down for 6 months, killed off the virus, and there's no more cases, no more daily cases, we're walking around and then, we suddenly bring in people internationally into the country again from a country that still has the cases of the virus, it's going to bring it back in again. So it's all dependent on how we address this as a country. All we can do is look after each other and, call people, talk to people, just say what you need, how can I help, what's happening, stay safe, follow the rules. Don't go and visit family this Easter. It's sad, it really is. I wish I could go visit mine. We had a big thing organized, had a big camping trip organized a couple of weeks ago, and we can't do that anymore. So it sucks, but it is what it is, and we just need to stay healthy, we need to stay safe, we need to help each other and get through this together. And I'm looking forward to sort of reporting to you guys the data that flows through in the next couple of months, see how the property market pans out, and hopefully we can sort of not take in the skewed data and really look at it from a relative perspective and see what is happening in the market if the charts will allow us to do that. I mean, it's hard enough to do when data is skewed in the first place. So and I think any predictions that you guys may be listening to or seeing out there, take it for a grain of salt. You can't, there's people out there that are saying, at the start of this report, they said that, they were showing how in previous pandemics or previous financial crises, the housing market was pretty stable and even rose afterwards. And, it's not a prediction, but you got to take that for a grain of salt. It might not happen in this pandemic. And anyone that's saying that the property prices are going to crash, 40, 50%, it could happen, but it hasn't happened before. It's happened in the US, it's happened in Ireland, but it hasn't happened in Australia. We're always under different circumstances. The debt bubble is huge in Australia, but the government are literally doing everything they can to keep us in our housing. So no matter what you're reading, no matter what you're looking at, just take it with a grain of salt. Don't get bewindled and swayed, and take a bunch of experts' opinions. Even though I'm not a fan of listening to expert prediction opinions because they're always wrong. If they got it right, it's because they're lucky. Just really take everything with a grain of salt, guys. We can't predict what's going to happen in these months. You cannot model anything in this current environment. So anyway, stay safe. Happy Easter. Obviously, anything that I've said today isn't financial advice or, it's just my opinion. This is just my insights and what I think and my interpretation of the graphs. I don't know your personal financial circumstances or anything like that. So just a disclaimer to say, take anything from a grain of salt from what I'm saying. It's just my opinion. It's not financial advice. So anyway, guys, stay safe. Good to see ya. Hope you have a good Easter, and I'll talk to you soon.